Silicon Valley Bank collapsed. Yes, it's true. My name is Amar Sujagic and welcome to my video. Silicon Valley Bank collapsed and was taken over by federal regulators. It was the biggest failure of a US bank since the financial crisis in 2008. Silicon Valley Bank provided financing US venture-backed technology and healthcare companies. Why did Silicon Valley Bank fail? Silvergate Capital, a cryptocurrency-oriented bank, declared it would stop operations and liquidate its assets, forced the California lender to sell a portion of its debt securities. Silicon Valley Bank concerned investors when it said it needed to shore up its balance sheet and raise $2 billion in capital. It was forced to sell bond portfolio at a $1.8 billion loss. In a letter to customers, the bank said it enjoyed the financial position to weather sustained market pressures, but also noted that customer deposits had come in lower position than forecast in February. Some credit ratings firms downgraded the bank's bond rating from stable to negative. The bank urged venture capital firms to stay calm. Panic spread among investors. Bill Ackman, the billionaire investor, said the Silicon Valley Bank could fail. Silicon Valley Bank failed after a run on deposits. It is the largest bank crash since 2008. Because of the shock from Silicon Valley's investors started to dump bank stocks, and other banks are also in trouble. Treasury Secretary Janet L.Y. reassured investors that the banking system was resilient. The Federal Reserve declared that depositors will have access to all of their money and that no losses from either bank's failure will be borne by the taxpayer. President Biden said the US banking system was safe and insisted taxpayers would not pay for any bailouts. The Justice Department opened investigation into the collapse of Silicon Valley Bank. Analysts said Silicon Valley Bank's collapse is unlikely to set off the kind of domino effect in the banking industry. The system is as well capitalized and liquid as it has ever been, Mark Zandi said. Bank shares in the US, Asia and Europe dropped following the collapse of Silicon Valley Bank, as investors angered about the general position of the banking sector. Smaller US lenders were particularly hard hit. The sell-off came despite them reassuring customers that they had enough cash to be safe from future shocks. Investors are concerned that the failure of Silicon Valley Bank is a sign of many other troubles in corporate sector. The assumption is that the risk to the rest of the banking sector is low, because the most of the banks spread their exposure across lots of sectors. On the other hand, the failure have highlighted the fact that many banks are riskier than they might look. Smaller banks that are disproportionately tied to cash-strapped industries like tech and crypto may be in for a rough ride, according to Ed Moya. Everyone on Wall Street knew that the Fed's rate hiking campaign would eventually break something, and right now that is taking down small banks, Moya said on Friday. The US government has long guaranteed bank deposits under $250,000. Few days ago, Treasury Department, Federal Reserve and Federal Insurance Deposit Corporation meant even customers with larger deposits will not lose their money. President Biden said, "Your deposits will be there when you need them." American regulators have tried to sell Silicon Valley Bank. They have also created a new lending program. It allows banks to use some of their financial assets as they means to get a loan from the Federal Reserve, America's central bank. This newly created program is some kind of a backstop to make sure banks will be able to meet all the needs of their depositors. Silicon Valley Bank is a lender for early stage businesses, so its failure led to fears to many other industries, from climate tech to medical research. And what does the bank failure mean for interest rates? The Federal Reserve has been raising interest rates to slow down the economy, but rising interest rates were partly to blame for this bank failure. The report showed US annual inflation at 6% in February, and higher prices highlighting the challenge for the Fed. There is a nervousness among investors about the next possible crisis caused by rising rates. Investors and analysts are declaring that the Federal Reserve will stop hiking rates in response to the bank failure, or even start cutting. And if you like my video, don't forget to click the subscribe button below. When the dust settles, it's hard to predict the possible ripple effects from this event. The whole sector is in crisis, and the banks and investors that support these assets are going to have to figure out what to do. And now tell me, what is your opinion about this topic in the comment section below. Even you are not financial expert, I'll try to answer them all. And see you in next video. Goodbye.